Wait,
Hello, I'm Steve Skancke, Chief Economic Advisor at Keel, and I'm excited to share our thoughts about the outlook for the U.S. economy and financial markets. As stock markets continue to set new records, we are regularly asked if stock markets are overvalued and headed for a correction. Stocks are highly valued by historical standards, and markets do correct regularly. Over the last 45 years, for example, stock prices have declined by an average of 14% within any given calendar year, even though stock prices closed higher in 34 of those 45 years. Already in 2025, the S&P was down 19% between mid-February and early April, but currently is up 16.5% for the year. Two things drive stock prices: growth in earnings per share and investor confidence in earnings growth continuing. In the current third quarter earnings reporting season, 85% of S&P 500 companies already are reporting earnings that have beat analyst expectations. So the outlook for continuing growth in earnings per share is positive and does not signal that stock prices are overvalued. The other interesting factor is that historically, when the Federal Reserve cuts interest rates when the U.S. economy is not in a recession, stock markets flourish. We've seen some of this already in the last couple of months. U.S. GDP growth has been resilient, and data released before the shutdown indicated 3.8% annualized GDP gains in the third quarter, implying average GDP growth of 2.3% so far this year. There is no doubt that the government shutdown was weighing heavily on consumer sentiment. It's created uncertainty and inconvenience for households, businesses, investors, and having to make decisions without good information. The current conditions component of the University of Michigan Consumer Sentiment Measure for early November fell to its lowest level since 1950, with consumers increasingly anxious about how the shutdown was affecting rising prices and weakening job prospects. We saw this anxiety spreading into stock markets as well. News about the deal among the president and congressional leaders, however, to end the shutdown has caused markets to rebound. The growing angst about the labor market is driven in part by not having good real-time government survey data. In 2024, the monthly new jobs creation averaged 168,000. May to August of 2025, new jobs averaged only 39,000. The immigration crackdown, use of AI, and cyclical weakness outside the main tech sectors are the reasons for the slowdown in private sector hiring this year. Last year, monthly payroll gains needed to cover new entrants to the labor market was about 125,000. With that, the unemployment rate remained steady. With virtually no immigrant component adding to the labor force, that number has dropped to about 50,000. So the limited information about labor markets that has been available has created worry about labor markets. It does not look like a recession is brewing, but even the Fed is erring on the side of caution about labor markets as it cuts interest rates while prices are rising. The president has deemed the battle for AI dominance a critical national security issue and is steering federal resources toward it. Until the end of October, investor sentiment towards AI remained upbeat. That sentiment waned over the past several weeks as investors have questioned the magnitude of AI investment requirements being forecast. Beginning a week ago, that sentiment turned downbeat, despite generally positive news on the earnings front. The outlook, however, remains positive as AI investment and adoption grows. The current estimate for capital investment from the major AI hyperscalers, that is Google, Amazon, Meta, Microsoft, and Oracle, in 2025 has been revised upward from $400 billion to $468 billion, and to $548 billion in 2026 to be paid from profits and current cash flow. Our graphic shows how both of these are working together to drive investment and growth. We have additional slides providing information about the economy and financial markets, and we'd be happy to share them with you. Please contact your Keel Point advisor or any member of our Keel Point team if you have questions or would like additional information.